Bridging loans are one of the most powerful tools in an investor's toolbox, but they can often always be misunderstood. A bridging loan can be viewed as risky, expensive, whereas actually that couldn't be further from the truth. If used correctly, a bridge could be the enabler between a deal actually taking place or not happening at all. In this video, I want to break down exactly what a bridging loan is, how it works, when an investor or developer should use it, and what to understand when selecting your bridging partner for your next transaction. Bridging, in its simplest form, is a short-term loan to assist and bridge the gap with the acquisition of a residential or commercial real estate transaction between acquisition and the sale or refinance of that property, and anything that has to happen to the security in between. Your typical borrower for a bridging loan is an investor, a developer, a first-time investor, or on the regulated transaction, somebody with a chain break transaction who wants to bridge between selling and buying their new home. There are a whole myriad of reasons for why people will use a bridging loan. The first could be when time is of the essence. For example, an auction purchase. When the gavel comes down and you have 28 days to complete. There aren't many mortgage lenders out there that can assist a borrower to complete in time. So you either need to be a cash buyer or you use bridging lenders who become your cash in that transaction. The other reason is when you need a little bit more flexibility and time to sell a property or to sell a completed development, or if you're trying to enhance value on an existing transaction where you're purchasing a property, adding value to it by either increasing a room, refurbishing that property, or creating a house into flats or one-bedroom flat into a two-bedroom flat. It's about enhancing value and then coming out the other side either via a long-term remortgage or via a sale. A bridging loan will differ from a long-term mortgage in multiple ways. First, it's over the term. A bridging loan is typically designed for 12 months, or in a refurbishment scenario or a developer exit scenario where a developer needs more time to sell units, you might want to go to 18 months. Whereas a long-term mortgage is typically you have a 2 or a 3 or a 5-year initial fixed or variable period, discounted period, followed by an amortization period of that loan over a 20-25-year period. A bridging loan typically will have interest deducted or added to the loan to allow an investor or developer the time and the flexibility to make a transaction work, whether it's enhancing the value of that asset, whether it's acquiring it for speed, but it's about that flexibility that a bridging loan will give to an investor. A long-term mortgage is typically one where you're paying the interest monthly or quarterly if it's a commercial asset, and whereby you're going to amortize that loan over a period of time. A bridging loan is typically a bullet facility where you take it day one. On a refurbishment loans, there may be some drawdowns, but that loan is repayable at the end. There's no monthly or quarterly servicing required in some scenarios. Bridging loans are typically priced based on risk. What I mean by that is risk is driven by the underlying asset you're lending against and what has to happen to that asset during the term of the loan, the borrower you're lending to, as well as how you're going to be repaid as a bridging lender. Now, all three of those aspects combined together will drive risk, which will drive pricing and leverage. From a leverage perspective, bridging loans can start as low as 50% and go all the way up as high as 75% loan to value. And from a pricing perspective, loans can start at the 0.65% per month along and go all the way as high as 1.25% per month, again, all dependent on the risk. There's typically a fee charged on the way in. Some lenders charge a fee on the way out, others don't. And ultimately, you need to work with a lender that's going to give you the best possible pricing and leverage for your transaction. Any investor who applies for a bridging loan will need to know that a bridging lender will always take a legal charge over the property they're lending against. Typically, that legal charge will be a first legal charge where you have primary security over the asset you're lending against. But in some scenarios, lenders will allow a second charge to be their form of security sitting behind a mainstream mortgage. Typically, this is when you have a very low rate buy-to-let loan or a very low rate mortgage already secured against the property at a low loan to value, and you just want a slight top up, maybe to assist with an additional investment, to assist with some liquidity on a refurbishment transaction. On a second charge loan, lenders typically will bring their leverage down because it is an increased risk sitting behind somebody else. Whereas if you're going to go for the maximum leverage from a bridging lender, they typically will want a first legal charge on the asset. There's also a difference in bridging loans between open bridges and closed bridges. What I mean by that, an open bridge is where you understand what the exit is, but it's not guaranteed and is not set in stone. A closed bridge, for example, on a chain break, may be where you've sold a property over here and you're purchasing a new property over here. You've already exchanged on property number one, so you know the completion date when that is going to happen, but you have to bridge the time gap between the acquisition of this property and the completion of this property. And that is what is defined as a closed bridge. Most lenders will lend where it's an open bridge scenario, again, only if they understand how the loan will be repaid. But these closed bridge scenarios, you're typically able to get higher leverage and lower interest rates because the risk is lower. Let's bring it to life with an actual real life scenario. We were approached by a borrower 2 weeks ago who had been successful at a recent auction. They were buying an investment property and they needed to complete quickly. They thought that they could do it with a mortgage, only for their mortgage broker to tell them there's no possibility they can complete in 28 days. They approached us with 3 weeks to go. Now here's the thing. The property being purchased didn't have a kitchen and didn't have a bathroom, so it is unmortgageable anyway. Prime candidate for a bridging loan. Instead of gearing to our maximum leverage, because it needed to be work done to the property to bring it to a point where it could be refinanced, what we did was we funded it at 70% of the purchase price. We then provided the borrower with a refurbishment facility to be spent in arrears of 100 grand. And by the time that loan was finished, we were at 65% of the end value of that property. The property refurbishment took 3 months. The borrower did it with a great team with a fixed price contract. And by the time it was finished, they refinanced us out onto a long-term buy-to-let mortgage, using the bridging loan for around 5 months, highlighting that flexibility and that when used correctly, a bridging loan is not expensive. It's an enabler. I've tried to highlight the fact that most people think bridging loans are expensive or risky, whereas actually the reality is that's the furthest thing from the truth when it's used correctly. What do I mean by that? I mean, when you're using a bridge because it's an enabler for a transaction to happen, rather than using a bridge because you have no other choice and you have no other options for finance, that's when it becomes expensive or risky. But actually, for investors out there who are looking to maximize value from transactions, or for traders out there who are looking to buy quickly and then renovate and sell, it could be the most useful tool in their toolkit. The biggest thing to consider on any bridging loan for any investor is how you're going to repay it. Too often we see people who focus on the front end and not on the back end. And I would urge all investors out there, when you approach your bridging lender, to make sure your exit is clear and deliverable. If that is the case, it becomes really cost effective and a superb tool for you to be able to grow your value. To complete this video, I wanted to highlight one final point. Using bridging lenders can be complicated if you don't know what you're doing. The best advice I could give is to use a trusted mortgage broker who understands bridging and also has access to the mainstream market. At Maslow, we deal with hundreds of intermediaries and mortgage brokers who truly understand bridging, understand when the best time to use it is, and also equally as importantly, when you don't need to use bridging. Finding that balance between the best bridging loan and a superb exit for that loan at the end is vital, and mortgage brokers play a crucial key in that role. If you'd like to get in touch with Maslow, please click the link below, and I hope you've enjoyed this video.